Whether you are a founder looking for funding or an investor who wants to build long-term partnerships, it all comes down into three things: trust, clear communication, and shared values. I am Montrepreneur, and in today's episode of the Montrepreneur Podcast, we will dive into expert advice and real-world examples to help you build sustainable business partnerships that truly last. Shamsi, thanks a lot. I really appreciate taking the time. Thanks a lot for being here.
Thank you for inviting.
Shamsi, I met you like 1.5 months ago. You told me the first time you're investor relations manager.
Absolutely.
What the heck is that? You're the first person that I meet that does that. So I would be curious, like, what's your personal like background and what does like an investor relation manager do?
Sure. Let me start with a brief explanation, actually, and I believe it's the best way to represent it for the person who meets someone like me for the first time. Investor relations manager is a person who tries to make a bridge between startup or any kind of a company and investors by representing their both sides interests. And it depends on what time of period you're representing whose interest. Why? Because mainly we're focused on making business work, right, as everyone.
Yeah.
And based on the situation, you have to take sides because of what's happening. When it comes to my background, I happen to be in that sector very, very unexpectedly for myself. I was working in a financial consultancy, and was a case when people were coming to us and saying, look, I have some amount of money to invest, but I don't know where. And we started helping them to manage their portfolio. Later on, startups were coming and saying, look, we want to attract some fundraising. Would you be able to help us with that? And that's how it happened. So mainly, investor relations manager is a person who builds healthy, sustainable connection from the both sides between business, either startup, either some manufacturing business, it can be anything, and people who put their money to make this business happen or develop.
Okay, cool. So you basically help like businesses or startups, like in this case, to raise money, but keeping like the interests of both sides, like the investors and the startups, right?
I would say the raising money part is not actually the most difficult or the most challenging. It's just the beginning of the party, let's say. So the problem is once you are engaging with the investor, there are many points to keep in your head. They might be interested in the idea, but they do not know how your business actually works. They might have a great experience in business, but they are not familiar with the industry. From your side, you might be a great person who worked in the sector for, let's say, it's a recent case which I had for 20 years. But when it comes to some processes or understanding how, for example, venture capitals work, nada. What they say in Spain, nothing. And once you actually have soft or hard commitment from the investor, the game just starts. You have to keep them, as you said, engaged, interested, and you have to make this relationship and this way very comfortable for the both sides. Since if you build a good relationship first, it's gonna be less hard for you easier for you basically to get out of this relationship in case if you decide to. And in case if you decide to build on it, you have a great base.
Okay, I understand. How would you describe like a good relationship or a good sustainable relation between an investor and a startup, like in the long run?
I will try not to be very utopic in that case, because of course the greatest thing which you can have with the investor is transparency. But we both know that my ex-boss was saying a very good quote, which actually was written in my head somewhere. He always says that everyone is focused on, I'm trying to translate it from Russian, everyone is focused on basically proving or guarding their own interests, right? So not everyone understands the interests of the investor is actually the same interests as yours.
Sure.
It's the quality, the achievements, the sustainability of the business process which you build, and in the end of that, as a product, the revenue, the money which you will get, because any result which you want to get from the business is money, nothing else. And in that case, many people forget about what they want to achieve and focus on how.
Sure.
So what you have to keep in mind when you're in touch with any kind of investor is that you might have different approaches in terms of how, but what should be aligned. And if it's not, that's not your investor, or you are not the startup for the person.
Yeah.
I would say three things. If you're a startup where the fundraising, the money is not the thing which is lacking, maybe you need some experience, maybe you need some good advice. First thing which you need to look is your investor profile, which is smart money, which is high risk tolerance if we're talking about early stage raise. And besides that, ability to actually hear your opinion and see where it goes with you. If you don't see it on the first stages, when the person tells you, okay, no, we will not build it in that way, you might get that money in your pocket and put it in development of the business. But it will be a huge headache for you. So the relationship between the business and investor is when your what is about the same and your how differentiates, but together in a partnership.
But I mean, I'm still reflecting like on the three things you said. You said smart money. And can you just explain them? Because
sure. Well, recently many ways of fundraising are becoming more and more popular. We can meet like revenue share model. We can meet like development instead of cash, and etc., etc. But when we are talking about classic fundraising, when it's money, basically, when it's cash, which you will divide into some parts and bring into development of your product, marketing, and other issues or tasks, goals which you might have inside of your business processes, is that the person, sometimes the investor, if you chose a wise, smart investor with a great experience in his industry. Because when we talk about investors, we have to keep in mind that none of them are fool. None of them are stupid or ignorant. That's people who became a bit, let's say, cynic. There is a word cynic. I'm not sure if it exists in English. It does. Great. Okay. I was translated it from Russian. So cynic, and they saw as many failing cases that they're like, okay, let me be a bit more logic and check it one more time before I say yes or do any kind of commitment. So in that case, smart money is about the experience and seeing a few steps ahead before the problem in your business happens. And that's your responsibility to hear why it makes sense. Let's say smart money is basically something what investor brings and sees while other people overlooks it.
So like more the advice and the experience in the domain, like much more than just like the numbers.
Absolutely.
Okay,
absolutely.
Great. What was like the second one?
The second one, wow, that's you caught me. You caught me. Okay, we said smart money. And that's definitely the main case. The second, which we said, and you actually caught me. I was so focused on what I say.
I forgot that as well. But if we remember, like maybe we can come back.
Guys, you should remind us. We were talking about the fact that besides the fact that investor should bring money, he should also bring some expertise, and also, of course, the way how you are getting things can be different, but where you're getting should be aligned. And if you're missing the connection in the very beginning, it's actually not gonna work, and you should not get into any commitment, because it's not only commitment from their part. You know, I saw many people who has some type of business or a startup, and once in some after soft commitment, the investor said, okay, sorry, but I'm not in, they get really upset and angry. But that's also our job as investor relations managers to say, look, that's completely fine, because once you are deciding to start a business where someone else is involved materially, like with their money, with their cash, it happens to be a huge challenge in terms of impersonal communication. And if you feel like, okay, you are struggling, but like, tolerating it just because you need that money urgently to cover some of your expenses, don't let it happen. Don't let it happen, because it's the hugest mistake which you can make in terms of like long-term relationship.
100%. That will rush everything and put you under pressure, and you're not able to negotiate that well. I forgot the question I wanted to ask, but I mean,
guys, it's Thursday and it's like 8:00. Don't be mad at us.
No, but I mean, so how would you approach like the whole process? Typically, for example, like I'm a startup right now, I want to fundraise, and for sure I understand like it's about building relationship, etc. So it's not like I don't know, like happens in 1 week, 2 weeks.
Course.
It's a long-term process, and after that it's long-term investment and long-term like expectations and alignment. How do you approach that, and what's the biggest challenges?
Sure, I would say that it really depends on what startup are you. Because, for example, when I'm thinking about particularly your project, there are many ways to get more attractive before you actually put your dossier or put your pitch deck on the table of the investor. You can use different ways of building groups. You can actually build a good user group before saying, hey, that's something you would consider maybe. And as an example also, now I'm working with one business, with one startup. And since the very beginning, the founder and owner was telling me, okay, we are B2C. Recently, I attended their advisory board. I'm listening and I understand that the business itself has much more benefits for the businesses than to the customer. It just brings the customer, allocates it and aggregates it on a one platform by bringing it some values, and then it's just irreplaceable and impossible to forget about it type of instrument, which will help businesses, local businesses, to raise their awareness, their customer abilities, and etc., etc. So what I'm trying to say there, since we were thinking about it as B2C, and we didn't hear owner talking about it as widely, we were approaching venture capitals or other types of investors in a particular way, where we're like, okay, look, that's the basically roadmap, and that's how we are talking about the customer. That's what the customer gets. And that's a very interesting project, because in that project, to understand it, it has to be either very risky person, either very into the sector, because it's about skiing, basically. And when we talk about skiing, if you are not familiar with the process, you don't understand. And when you're talking to the investor from the customer perspective of view, he's like, I don't ski. I don't really understand what you're talking about. When you're putting it aside and saying, look, forget about skiing. That's how the businesses will benefit from them. That's where they make, okay.
That's it's basically like flipping the coin and just talking in a language of the other person, in front of you. In this
Besides that, that's a huge actually inner work which the founder should make before getting into any connection or any engagement with the investor. He needs to understand what actually he's selling. What is the value proposition for each user group, and which one of them is most understandable, sustainable, and proved in terms of revenue streaming model. So it will help him to create a base of evidences, of proofs for the investor to understand why it makes sense.
These user groups, like you're not talking only about the product itself, for example, B2B or B2C, you're also like talking about all the other parties, for example, like the investor, etc., etc. What kind of how would you like align all these, I don't know, like interests together? Because usually like what the clients needs from the product is basically not what the investor needs, for example, like interest or like profit, etc. So how would you like make it interesting for the investor, although make it interesting for your users?
Sure. Okay, the biggest problem here, or the biggest question which is investor usually has when you're coming with some kind of idea, why the customer would pay for it.
Sure.
You hear it every time. They come up sometimes with you give them an explanation, but they're like, okay, like tell me, tell me, and you can see that they are not there. They do not feel you. They do not get you. They do not understand what you are talking about. Mainly because the user experience, the customer experience, which you are considering while talking about it, is far away from their personal experience. So what you do there? You talk to them in numbers. What I mean? For example, let's say we are talking about pet care industry. Did you know that 54% of the owners of the dogs regret having a dog?
No.
Imagine.
Okay.
And there are many reasons. Some of them because they don't have time to take care of the animal, of the pet. Some of them because they didn't expect it to be such huge responsibility. Others just because they happen to be not a big lovers of having pets, and etc., etc. So once you will come and tell, let's say you're creating a startup for the pet owners, and you tell them, to the investor, you tell to the investor, I will solve the problem of the pet owner. Do you have pets? He's like, no, I have kids. And you're stuck with it, Instead you say, do you know that 54% of the pet owners regret actually having a pet? He's like, no. Do you know how much they spend to not deal with that pet? No. That's how much. And that's what part of it I can get. Of the market, That's the percentage of the market which I can get. That's the whole size of the market, and that's how much this market annually makes.
Okay, so firstly, like confronting them with the problem, then like a lot of people have this problem, then like how big the global market is, and then your solution.
Yes, absolutely, and important to mention that the problem needs to be as less categorized as possible. So what I mean is that should be a problem which is understandable. If you come and say it's hard to walk a dog every night, he will be like, I don't know, I don't have one. If you will come and tell him that's hard to, like, let's say, book a ski trip, in nowadays, like you don't have all the instruments necessary for that. They're like, I don't ski. But once you talk to them through the perspective which is understandable, they get it.
Okay. But if we like get through, so identify the problem, the global market is good, a lot of people use that, they understood that. How to move on, because usually you have like a lot of people or a lot of competitors working in the same problem. How would you convince the investor that you're the right person and your solution gonna make it through?
Sure. First, I saw many startups actually giving up because they have competitors, and that's a biggest disappointment for me usually, because look, and I'm telling it to you guys, actually.
Look.
If you have competitor, it basically justifies your revenue model. It basically justifies the fact that if there is some existing company which is already making money, then you can make it too. And unfortunately, that's the reality which we all need to accept. There is no blue ocean in the world anymore. Until someone invents something similar to artificial intelligence again, there is no blue ocean. It's not red maybe somewhere, but there are still some competitors. There are still some players on the market which do part of what your product does, or maybe everything. And you will think how to evaluate it. Because, it's not always about how much you give. It's about how you give. Like, what is the quality of the product, service. That's a good case, which everyone, I'm pretty sure, knows, with Uber. Because, like, basically, you can order taxi, but you're ordering Uber because there is some particular feel of safety, right? You know that, okay, there will be a guy who will open you a door, you will sit, you know that there is a water in the car, and etc., etc. And once you are ordering free now, well, you are not quite sure of who will be driving, of what will be the quality of the car, the conversation, etc., etc. So once we get into the relationship with investor, and he asks you, okay, great, but you have some competitors on the market. What are we gonna do with that? There are a few main points. First, make a statement and say, these competitors just justify my revenue model. Second, there is no way that the startups come up with something and starts doing some product without understanding who are in the market already. So that's your responsibility to do or find people who will do some due diligence and understand what are the weak points of your competitor, if you can fulfill that weak point, and how. And in case if your product does not happen to fulfill that problems now, great. You come to the investor, you say, look, I identified the reason why they're losing money for last year, or why they were sold to that company, or look, I found out that they have a debt of $2 billion, and it happened in one of my cases, actually. This is the reason, this is the risk which they have, this is how they are proving risk, so they happen to be in a trouble. That's my product, that's what I want to implement to solve the problem which they're having, and that's why I need money from you.
Okay, cool. So actually I didn't think about that before, like to do the due diligence, like from the perspective of me as a founder for my competitors. Usually the ones who do due diligence are like the investors if they want to invest in a company.
Sure, but you are the main and the most involved investor of your startup.
This is a good one.
That's actually like this. You're basically investing something what is much more valuable than anything. Your time, your dreams, your energy. I just can't imagine myself, because I'm a very rational person, right? I can't imagine myself sitting nights and days on idea without knowing that it makes sense. You know what I mean?
Yeah, I know exactly what you mean.
Sorry, I mean, if it makes sense, right?
Yeah.
So, yeah, we were talking about the fact that the founder has to do due diligence, and that's the first thing to do once you have a sparkle in your head. You get the idea, you divide it on, okay, how I make it happen, and while you're going through every, like, say, checkpoint on your roadmap, you criticize yourself. You understand if it makes sense. You see who else is doing that. Who else is doing something similar? How are they doing in terms of business? What is their, like, revenue? How much they invest? How much was invested in them? How much they fundraised? What is their social media? What are the comments in social media? How is customer satisfied by the product? If not, why? How you can make it better, and etc., etc. And that's exactly what you should come for the investor with. That, look, yes, there is a market. Yes, there are players on the market. And look, they were making money, even though they have these problems. And I'm gonna solve it this way, get my business plan. Let's make it happen.
Okay, sure. This is actually a very, very good one. Okay, so again, we identified the problem. There's a market there, convinced the investor, and talked about the competitors, and convinced the investors that we are better than them, and we are going to solve the problems. There are like many types of investments. I think it's very, very individual, like to decide like for which startup, like what's the best investment way to go. But how do you approach that, and how does the process look like after that until getting really like the check?
Well, it's, as you said, it really depends on the type of investor. Because if you are talking with, let's say, angel investor or some type of private investor, the conversation usually flies smoother. And it flies if the person is actually involved. You will feel it. With the VCs, it takes time.
Yeah.
Because it's always, as we said, due diligence. It's always like, okay, send me your pitch deck. Great, let's have a call. I will hear that pitch deck from you and maybe even see it for the first time while talking to you, but we will never mention it, right? And it happened a lot.
Yeah.
And that's also a problem which should be considered in your head. Don't assume that the investor already saw it.
Yeah.
Do it as for the first time. Don't say phrases like, oh, you probably saw it. Oh, I probably mentioned it. They don't remember. They saw 100 of them. You remember we met actually once at a meeting for startups, and there was a great guy investor who was giving a speech, and he was saying, the moment when I'm attending some kind of event and you are the 500 ones guy who is approaching me and saying, where do you invest? Do you want me to pitch you?
Yeah.
Like,
I was actually in an event yesterday with this guy.
Yeah? How was it?
It was funny.
Yeah, he is funny, but his statements make sense.
Yeah.
His statements make sense a lot because you're sending the pitch deck or one pager, whatever, and you believe that the investor will go through it for sure.
Yeah.
Unfortunately, no. The VCs go through hundreds of pitch decks daily. Angel investor, he picks. You need to be lucky to get in contact with the angel investor if you don't have an initial contact. You know what I mean?
Yeah.
So once you are in a call, do the best what you can. So later on, once you did it, it's the problem of differences between the type of organizations. Some of the VCs act really fast because there are some what you call active type of VCs. For example, every year they fundraise from their own sources and they have to get rid of the cash by the end of the annual year. But there are other type of investors, of the VCs as well, which build what's called dry powder. Dry powder is the money which was fundraised by the VC but was not invested in the companies, in the startups, in the businesses. By the way, for example, this year, I was just, since you're an investor relations manager, you have to be very updated in terms of the market situation. And I was checking like the last reports which came up, and the majority of them say that this year, the percentage of the investment dropped rapidly. In USA, it dropped from 58 billion to 41 in VC investments, and in other sources, in National Venture Association source, it says from 35 to 40, it like differentiates the number, which means that, the VCs are actually saving money for something. They are building the dry powder. Maybe we're expecting some boom. I thought AI will be that boom, and we see that they're actively investing in AI. Probably there is something more coming up. That is why once you are in contact with a VC, which is not actually ready to invest in anything, it's not about you, you have to give them their time and keep them updated. Like on a weekly base, it's actually, there is a funnel of sales, right?
Yeah.
In marketing. There is the same funnel of sales with investor. If he is not ready now, it doesn't mean that he will not be ready in 5 months or in 1 year or maybe in 2, because running a startup is actually as running a marathon. You never know when it ends. So if you are in touch with the active VC, the best thing which you can do is keep the communication with them as rapid as you can. Because it happened to be in my personal career as well, when I made mistakes in the beginning by not updating them as soon as possible.
Yeah.
You lose their interest like that because there are thousands of them.
Yeah. I actually it took me also like a lot to understand that it's actually a funnel. It's really a sales funnel.
Yeah.
I was like talking to a founder like 2 weeks ago, also like on this podcast, and he was like telling me he sold like his startup, and he was like, and I was like, how was it? He was like, exactly the same as every sales like process I ever did. It was like updating them, going like on a call, telling them blah blah blah,
Yes.
and then just like. So actually, if you broke everything down, it's not as complicated as a lot of founders think. And just as you said, it's just logical. It takes time, but if you did the steps, you will higher the probability like to get the money. And getting the money is not the hardest part, but a lot of startups think that it is the hardest part and it is what they need, which is actually not the case, in my opinion. Yeah.
And the thing is, unfortunately, founders think on their idea a lot, but do not actually put their head or put their effort into building a well thought fundraising process. Because, of course, you can like go to LinkedIn, type investor in a buscar, like in a search, and text to every single guy. And maybe it can even gonna work. But what you need to do instead, sit and think who I need in my team.
Yeah.
What type of people I need. Because I saw that many times when great founders come to the call with a VC or with an investor or interpersonal meeting, like in real life, and they lose themselves. Like they start selling themselves. But it's not only about you selling them your idea. They are actually also someone who you are considering, right? Because you have your product, they have money, but you put in that product something much more than just that money.
Yeah.
And while you are choosing a person who will affect maybe the job of your life, maybe the project of your life, because that's what they want to see, right? They don't come to me if it's not a project of your life. Don't come to me if you would not put your money in here. If it is a project of my life, tell me about you.
So it's actually what you're saying is like also from the founder's perspective, they have to interview the investor and to see if the investor like fits in the team, because they will deal like with the investor like very long time, right?
I would put a different word, not interview, but I would do my own due diligence on the investor for sure. That's what we're doing with our customers. Once they come to us and say, look, that's my project and that's how much money I need. First we question why you need that much money. Because we need to understand. We need to be, in case if the founder not there, we are just representing his interest, or we are approaching our own personal database of investors, or the founder is not that type of not the presentation type of person. That happens a lot.
Yeah.
Especially in some kind of a fintech or technical products. We're like, okay, justify us, so we make sure that you can justify it to an investor. And once we talk later on, we say, great, let's think about who you need in your team. And okay, where this person invested before? Where is he from maybe? What is his interest? What is his risk tolerance? Building whole investor profile. Usually building investor profile take us around 4 days and good like 70 pages document. Because in that document you also put everyone from the list which you have, like your personal database of who might be a good fit. It's similar to Tinder dating basically.
Yeah, actually.
Very much, because if you are dating on Tinder not just to have fun, or not at least just to, see the good looking person in front of you, or checking like, okay, like she is, I don't know, her interests are not something crazy. She's like into something besides astrology. Great. You know what I mean?
No, I totally relate,
Yeah. So, once you have a great understanding of who you want to approach and who would be interested in your product, who would be a good match, you do let's say, help me to find the word, like you do not shoot there. You find a target and shoot it exactly there.
Because actually that would also like higher the probability that they will answer or they will react, because a lot of people just reach out like to everybody. That will burn like a lot of cards, and a lot of people are just not interested,
Of
so
course.
they wouldn't even listen. Okay, cool. What would you say like the difference between building a relationship with an investor like in the early stage and like on a company growth stage, you know what I mean, like post investment? Okay, you're at the early stage, you believe in the idea, etc., but you have some revenue with the time, you grow the business, etc., you're like an established company a little bit. How would you say that things change like over time?
The thing is, I saw that a lot, that the relationship with the investor become more problematic over the time, because it's like any work type relationship, right? You hire a team, you start working together, and you forget to send an email. And that happens. We are human beings. You forgot. But the person, because of that, didn't deliver something.
Yeah.
And that he will hate you forever. He will you will ask him to bring a coffee, and you should not drink that coffee because you never know what happened to it, basically. So with the investor, it's similar. From the investor perspective of you, even if he's not involved into the operational process or into the like development of the idea, he's like, or team of them, like VC, are like, okay, we are there. Why we don't know anything? Why we don't have transparency over the project? Since on the one more event which you also attended, the guy was telling, look, we don't want to be that guy calling from the bank and saying, look, that's the time. Why? Where is the money? Right? If we're talking, for example, about the VC loans, or if we're talking about like you had very good revenue or very good turnover in the first quarter of the year, but once you get to the last quarter, there is nothing left. There are like the burn rate of the team of the company is crazy. The team members are not doing a great job, and you can also see it based on the results. The customers are leaving and not continuing with you. And if there is a gap of not being informed for the VC, of course, for them, it's like a cold shower in the middle of the, winter in Russia. They're like, okay, thank you very much. I don't want that. Why am I there? So what you really need to do is take them as an equal part in a game. They are on your side, first of all. Second, if you have a problem, great, inform. Second, after you're informed, if you can ask for advice, because they have a crazy experience in terms of serial entrepreneuring, right? That it's might be first or second business for you, but for them it's 200 second, most probably. And after you make sure that you are at least honest with them and clear and transparent with them, put it on a regular basis. Once something happened in the business, you don't need to like daily update them. They will get tired of it most probably. But once in a month on an email, and especially if you don't have one investor but a few, you say, look, that's how the business changed. We are performing. So in case if something happens, they are aware of it. It's not a surprise for them. Investors do not like surprises. We know that very well. That's the most important.
And then you just mentioned, like, I think the second or third time, just updating them.
Of course.
I have the feeling that a lot of founders, especially like smart ones, don't like send updates if not a big changes happen in the business. You know what I mean? So if they didn't feel like they achieved I don't know, like the next it's a product or whatever, they wouldn't like send that for the investor, not to waste their time, but actually this is the wrong approach.
And that makes sense in a case and in a way that founder actually he has his own vision or understanding of the business, right? And updating, like you can have 100 potential leads. You can squeeze it to 50 most important and 20 priorities, right? To update these 20 priority people, you have to keep in mind your conversation, what you were talking about, what were their concerns, because it should not be just, okay, this week we attracted 5 more customers. No. What was their concern about? Maybe it was about partnerships. Maybe it was about logistics. Maybe it was about the security of data. Look, we're working on it, and that's what steps we took on a way to actually, prevent, solve, and etc. or develop. And that's where there should be great divide between the responsibilities in the team. I understand when the founder is alone, that's like he is everyone, like the marketing person, the person who thinks the strategist, finance, and somewhere in the between brings coffee to the everyone, just because he's hosting someone to tell about his product. But that's great thing to do, to have someone who will keep the track of what's happening with investors. What are the points which you talked about? What was the last, exclamation mark which the investor made? What are his biggest concerns? And then, besides overall information and summary of where the project is, talking to his pain points, to his insecurities in your project. And of course, that's not something what is easy to do while you're alone.
Sure, 100%. When talking about a relationship, with an investor, is it a long-term relationship, or usually investors do an exit, or they invest to do an exit in 5 years or something?
It really depends. It really depends. Of course, mainly, as we said, the main purpose of any business is making money. Usually, if the product makes a big boom, the investor tries to get out of it in a particular period of time, because you probably heard about it as well. Unicorns fail a lot.
Yeah.
They fail like crazy. That's the big bubbles usually. And once you pop it, because they were solving the particular problem on the market on a particular time, that is why it boomed, right? It was, how do you call it? It was water which put the fire down. But once there is no fire, there is no need in water.
Yeah, sure.
If we're talking about some sustainable products, that's why, for example, the investments in healthcare are growing, in fintech are growing, because it's solutions which we need. And in case if something changes in the market, you do not forget about solution. You build on it. You know what I mean?
Yeah, I know.
So in that sense, it really depends on what type of product are you, and what type investor you are talking to. I also saw the situations where the investor is really interested in a sector himself. It's his soft spot. And that happens a lot in case if you are targeting the right people. You are bringing on a board the person who is not only will participate by money, but he's also I want to make it happen because it will make my family members or my friends' life better. Even if it's just
that's the best case, yeah.
Exactly. Even if it's just about the plans for the weekends or taking his pet out for a walk, whatever. If we're talking about VCs, mainly there are more less emotional approaches, right? They look strictly to the numbers, and many startups has a tendency to, I will use a rude word in that case, to make numbers sexy. Don't do that, because VCs mainly understand what's happening. They will do their research on the market.
Sure.
They will see that, okay, that makes sense in terms of market, but it does not make sense in terms of the resources which you have. And what also many startups do, they try to make the numbers which they will achieve, the revenue higher than it will be, and keep the check of the investment low. It will not make sense. No one, as I said, in the very beginning, the investor never treats you like a fool. That is why he's really attentive and serious with you. He treats you like an equal, actually. Will you treat him as an equal? Because it's an important part of it.
Yeah.
And once you understand who you are having a talk with, you will definitely get to the point when you ask, is it a long-term relationship or not? And that's also something to talk about on a table. You will sense it, but it's never wrong to confront about it.
It's actually a very, very good point. I mean, like, I'm reflecting right now on many points you said in the last 3 minutes, but you just mentioned like the exaggerating with the numbers. I saw like very, very smart people like pitching their startups like 5 minutes before the pitch, just like change like the number from 10 billion to 30 billion. I was like, okay, why? And exactly what you said. I mean, the investor is not a fool, and that will put you like in a much worse situation. But how would you approach that actually, like to look to pitch the number like in an attractive way to the investor while not like exaggerating or not also like going the other way completely, like I don't know, saying it's, you know what I mean? I mean, not exaggerating, but not completely the opposite. Underestimating that, yes.
If you are talking to the VC, for example, they will also always ask for valuation. And you can do this valuation yourself or order from somewhere. We usually help to do valuation. And when we do that, that's our approach. We do 3 types, like as most probably all companies which provide that service. We do pessimistic, realistic, and optimistic. What the investor wants to hear from you on a first meet while you are pitching, right? Or while you are just walking out, running behind him on some event and saying, look, wait, there is an opportunity. He wants to hear the correlation, actually. Because if the market is like that, like many people are scared that the market is big and I'm taking a small piece of it, that will not be attractive for an investor. Why not? If you are taking a small piece of it and making a decent amount of money out of it, it makes sense. Because getting a small percentage of the market is easier. And the investor will know for sure that, okay, for that, he needs to develop the product, he needs to attract some good marketing, he needs to build logistics, and that's where my money goes. So once we're talking about making the numbers relatable, how not to underestimate them, is to understand what are you trying to be. Are you trying to be the leader of the market? If yes, can you be? Are you trying to challenge the market by bringing new opportunities? Great. How much do you need for that? And what it happens to be a niche product, right? How many customers will actually appreciate it? So what I'm saying is to be, as a founder, you need to be very critical towards yourself. And I know how hard is it once you're involved in every single process of your company. You're basically, at some point, everything becomes blurry for you. And you can approach, I don't know, ask your friends with some expertise in business, come and have a quick session with the investor relations manager and say, look, I don't understand how I can make it attractive. And they will tell you, okay, like, for example, this part makes sense. And this part can make you achieve this amount of money. Based on that, maybe you cannot ask for the check which you're asking, but go for the 0 to 1 strategy. Sure. When you are building one thing which will bring you revenue, and based on that, you will get to the point when you are building a long-term relationship with your investor and he understands why he reinvests in you again.
Yeah, it's like bringing everything down like to milestones, and just if you're promising you're going to make, I don't know, like 10K in 3 months, so prove that, and then we can talk about the bigger numbers. Absolutely. That was actually the advice that an investor told us like in the last startup I was working on, because we were like asking for exactly the same failure, like for the whole amount, but why actually? Okay, I will give you like the money, just achieve that, and after that we can talk.
Absolutely.
You were talking about I forgot that too, but I had a very, very interesting question actually. I was taking that. As you mentioned, it's Thursday.
Take your time.
I forgot it, but I mean, aside of that, what kind of like advice would you? I mean, you were also like in the startup space before, so you were like in the startup shoes and also like in the investor shoes. What kind of advice would you give like the founders and the startups to be more like, I mean, to take a step like more into the world of I mean, what kind of advice would you give like to startups or founders that talk a little bit more friendlier and more like in the language of investors? You know what I mean?
First thing, I would say that the founder, don't wait until the investor will tell you about the blind spots or the problems of your business. Do the due diligence of your business your own. Once you do that, you know what to approach with the investors. So there is no ideal business models in the world. It will be a weird example, but I feel like the economy and politics are really similar. It's connected and similar. And we are all up to democracy, to the liberal rights now in the modern world. But the democracy was born in ancient Greece. And the person I came up with that example. I don't remember who said that. I believe it was Aristotle. He said that the democracy is the most imperfect way of managing, way of political structure.
In a business, for sure.
But nothing better was invented.
Yeah.
You know what I mean? So in that sense, having problems is fine. There are no perfect structures. Also in business, we can talk about utopics, and many VCs want to see the utopic picture, but they know they will not. That is why they're that, very strict to you once you come to them. They're talking to everyone and checking your project from the very pessimistic point of view. And that makes sense because, for example, this year, the percentage of the startups failing is 60% more than last year.
Okay,
60. Many reasons. First, because the investors are not ready to make hard commitments. And from their point of view, it makes sense because the market develops much faster than it was a few years ago, because the interests and the focus of investors is very particular. And you can see how everywhere the investment is dropping, but AI is getting all that money all at once. And from the other hand, if there are 10, let's say AI-based startups getting investment, 7 out of them will fail because the other 3 will solve everything what others do. And it's actually a very, very big problem. Why? Because the VC cooked businesses, like the businesses which come out from the VC background, happen to be providing a job for 4 million people. And if the startups fail, it's a huge breaking spot, a huge corner stone for the economy. And what I was talking about is that before going to investor, identify your problems. That's completely fine. When you're doing 0 to 1 strategy, when you're building your product one by one, you go to him and say, look, that's where I want to get, but that's what I want to start with. I know that it's not solving what I'm supposed to solve yet, but I know that it's a great base to do this. And that's how I'm going to do this. So just try to simplify and break it on the milestones, and as well make sure that you are talking to the person who is on the same page with you. Don't shoot everywhere. Shoot exactly where you need to.
So a good point. What I'm thinking of right now, even like if you're building the product like milestone by milestone, even in the earliest like 3 steps, if you're like making like very, very small revenue, it's much better than aiming for the very high revenue at the end of your end goal, Because I was like, by my first startup, I was like, yeah, okay, it's totally fine if we didn't make any money like for the first like 5 years, 10 years. No, I mean, things change, market change, and a lot of predictive things can happen, and you cannot just like have one, I would say, like shot in the blind, and that the end goal will solve all the problems. It's much better to make the business work and the cash flow really works from the first steps, and then grow that like with the time and then fix the other problems.
For sure, because it's mentioned everywhere and everyone is feeling it, even in our personal life. The world is speeding up. and your idea will not make sense forever, basically. So, as I said, if it solves the problem of the market now, make it happen. Make it more simple. Make it happen to be one of those products. And then bring it to the another stage. When you talk to investor, you say, look, I'm going on the way which my competitors went because it works. And that's what I'm gonna build on it as a base to be better, higher, bigger, to make more sense, or just to make it work in a more qualified way. That's
Cool.
it.
So very, very good one actually. I mean, I don't have like any more questions in mind, but I would leave the stage for you right now if you'd like to share like anything that you think it's like interesting or like.
I would, for me, like I believe I've been like reflecting on everything what was said, and if you would ask me to, in general, break all that dialogue in one sentence, I would say that the founder should be very involved into the fundraising process with his head, not only with his effort, or her, which stands for, before taking an action, understand why you are doing it. Otherwise, you will find yourself with thousands of emails, fulfilled applications for the VCs or accelerators with getting no response. Because you can sense it when the person doesn't know what he or she is looking for. So that's pretty much it.
Okay, cool. I really, really appreciate it. I learned a lot. I'm reflecting right now like on many points. I will watch like that again and reflect more. But where can people find you and reach out to you?
You can find me on LinkedIn. I believe you will leave some kind of
I will leave that in the description.
Yeah, and that's the best way to get in touch with me, or any kind of investors also, by the way. One more tip there. So that's it.
Okay, great. I really appreciate it, Shamsi. Thanks a lot.
Thank you.